Let's talk about the process for new construction when you're not buying from a builder. Meaning, if you're buying from a builder, pick any builder you want, and they own the home, they're building it, and you want to go in and buy it. That process, for the most part, when it comes to mortgages, is pretty straightforward and pretty normal. Yes, there's some twists and there's some things that change. So don't get me wrong. And we do have a whole on mortgagemark.com. There's a whole section for new construction and what differs. But fundamentally, you're still buying from a you're buying a house, but by the time it's completed, you're buying a completed house from somebody that just happens to be a builder. Yes, you might be able to pick colors and things like that along the way. And yes, you might have to put up some bigger dollars up front for custom, putting stuff in. But the process itself for the mortgage is about the same. So what we're going to talk about here is like if you're trying to actually build a home, like you own the land, and maybe even the builder owns the land but hasn't done anything. It's going to be a custom build. In that case, that is a different scenario. So if you own the land or they own the land, it's all the same. So at some point, somebody's got to own the land, right? So if you're buying this lot or maybe a house that you're going to tear down and you don't have a builder yet, that's going to be one loan. Purchase the house, maybe you get some money, maybe you pay cash and you scrape it, and now you got a lot. Well, now that you have this piece of dirt that you got a loan on it, or maybe you paid cash, but let's say you got a loan from a bank, it's got a land loan. A lot of times those loans are 12 to 24 months because they don't want them very long. They're just saying, hey, we'll get you a loan. And now you go find your builder. So now you go interview builders. You like a builder, you commit to a builder, you then get plans, specs, budget. They give you the blueprints. You figure out what you're going to put in the house. The builder can then say, okay, cool, I'm done. And here's what the house will look like. Here's what's going to go in it. Here's the budget. You get all the plan specs and budget done. And then you go then to a bank, typically, or a lender, mortgage lender, either one. And you say, I now need a construction loan. And so the construction loan will pay off the lot loan. And they'll kind of think of it like a refinance to some degree. They're just going to say, cool, bring the lot into it. Yes, you get credit for equity that might be in there. So you bring the lot loan in. So if you owed some money, they pay it off, and then they start a line. So snap our fingers, pretend everything just went perfect and it closed. You get done, and they then give you a line of credit so that the builder comes and says, cool, now I need to go put in the foundation. They pull out some money. They go pour the foundation. Now they come back to the bank and say, see, we used all the money for the foundation. I have my next round of draws. I needed to put the framing up. They give them more money, and it's a checks and balances along the way. The builder then, based on the plan specs and budget, says, here's what I need at these intervals, and they do it. And so over time, the balance gets bigger and bigger. So as months go by, the payments, because the balance of the mortgage gets bigger and bigger, the payments get bigger and bigger. Then fast forward, however long it takes the builder to build the home, let's just say 12 months. The house is now perfect, pretty, and complete. You then get to go and say, cool, now instead of the construction loan, I now need a, quote, normal long-term mortgage. Maybe it's a 30-year fixed rate. And you then basically get the new 30-year fixed rate. So depending on how you set up that construction piece, that conversion can be what's called a modification if you did a one-time close, meaning you did both the construction loan and the permanent at closing of the construction. Maybe you did both loans at once. That's a one-time close. Or if you just did the construction loan, now it's doing the permanent with it has a refinance and getting that done. It doesn't have to be the same lender if you do that. So the answer is somehow get access to the lot, right? The builder already owns it. That just minimizes a step. You don't have to go buy it. You just build on the lot, and then you get a construction loan, and you can do one of two things. Again, you do one loan, like a one-time close, where they give you both the construction loan and the permanent. You do it all at once and you're done. So then you just modify later on. Or you do a two-time close, which is you get one loan for the construction, and then once it's done, you go get the refinance for the permanent. There's pros and cons to both. I can argue why both can be good, depends on the market and what you're doing. So that's not going to be for this purpose, but that's the process. If you have any questions, let us know. It is a lot. I get it. Feel free to give us a shout. We'll walk you through, and depending on the market, where rates are, what you're doing, how long you owned a lot, how big the house is, we'll help walk you through whether the one-time close or two-time close is going to be better for you. And if you have questions or comments, feel free to reach out to us. The Mortgage Mark team is always here to help. And remember, when you think mortgage, think Mark.